G'day folks, and welcome to a Check on Chain update for the 9th of July. So what I want to do today is explore actually a blend of technical and on-chain data. Now, you won't see me use technical data overly often, and that is not because I don't believe in the technical analysis side, right? I certainly have a lot more experience in the on-chain world, but by and large, I have found that on-chain and technical often align more than you would think. Now, one of the levels that I do use is Fibonacci levels, because for whatever reason, the market just seems to like to respect these levels. Whatever it is within our human psyche, natural algorithms, and these are self-reinforcing prophecies, the more that people look at these Fibonacci levels in analysis markets, the more that they show up, the more that people respond to them, and the more likely they are to occur. Now, more often than not, we actually have a lot of on-chain models that line up almost perfectly with these. And I want to use this to really look for flaws, understanding what my general frame of reference is, how I think about corrections like what we're currently in, and essentially, how do I prepare for the future that is, quite frankly, unknowable and unpredictable. So that's what we're going to be looking at today. So as I mentioned, these Fibonacci levels often line up with on-chain data. So really what I want to do is just use that as kind of a background story. I know a lot of people are familiar with using the Fibonacci levels, and I think that they do work. Really, it's a bit of an art, right? It's all about whereabouts you want to draw from top to bottom, how you want to actually measure these things. But what I want to show and really demonstrate here is we're trying to find levels of conviction, points in time where we can expect investor behavior to change. When do we see that investors move into a degree of financial stress, or vice versa? When do they actually move into a more profitable type scenario? So today we're going to be primarily focusing only on if the market goes lower. So because we simply have no idea which way it's going to go, we're going to be really focusing in on what happens if the market goes lower, where are some areas that we can expect that support to come in, and how does it look from both a technical and an on-chain perspective. Let's get stuck right into it. Okay, so where I want to start today is looking at some important cost basis models to really set the scene, but also identify analogous periods in the past. Because as always, it's useful to understand when investor behavior reaches a similar threshold, how do people respond? How does the market recover or not recover from certain moments in time? Now, what I've got laid over here, this is our key cost basis models. I've got two. One is the short-term holder cost basis, which we've obviously talked quite a bit about. This is the cost base for people who've acquired their coins in the last 5 months. Now, given that 5-month window, we are pretty much talking about everybody who bought higher than where we currently are. So really 5 months ago, we are talking about this current consolidation period and below. That's our short-term holder cohort. And we also have the 200-day here in the dashed line of the purple line, because the 200-day is one of these long-term moving averages. Every man and his dog in markets is going to look at it. And a lot of people say it is essential, like a bull-bear bias. If the price is above it, we can have a bullish bias. If the price is below it, we can have a bearish bias. Now, as we covered last week, the fact that we are now below both of these is important. And as it stands, until one of those two changes, right? Obviously, we will break through the 200-day before we get to the short term, if that was to be the case. But until we really start showing some strength in getting above them, and we are consolidating below the 200-day, I'm going to be respecting this as a downtrend. And, in my experience, I've kind of taken I've paid my tuition many times. Every time that I don't just respect that it is a downtrend until proven otherwise, usually I get I get something handed back to me. So what I want to do is just look at different scenarios, which are somewhat similar to where we currently are, and we've broken below both of these two models. Now, 2019 is the first one that comes to mind. We sliced through them and we rallied from 4K to 14K. We sliced down below both of them, and then we essentially had like a miniature bear market / chop solidation down in this period. Now, when you hear me talk about 2019, listen to when I say 2019, chop off March 2020, because that's an anomalous period. And a lot of people, when they say 2019 and they think about 2019, they actually think about March 2020. But when I talk about 2019, I'm almost exclusively talking about this chop solidation period where for 8 months, we went absolutely nowhere, but we took out longs, shorts, and everybody in between during that process. Now, in terms of sentiment, just like an anecdotal level, 2019 feels like today. This is by far, in terms of like what it's like to be in this market, for those of you who weren't around for 2019, where we are right now, almost identical in like this, just the general sentiment, at least from my perspective. So I think 2019 is a good example and just something to pay attention to as a mental model. Now, there's two other examples in 2021. The first was the May sell-off. Now, this was brutal. I will do a report sometime down the line where we actually look at what happened during this period because, obviously we want to look at double tops and all these types of things. But what we did is we sliced down. This started the bear. This sell off from 64K when Coinbase went live in a direct listing down to 29. This was brutal. This destroyed sentiment. Even though we got back to a previous all-time high or a new all-time high, this just didn't have any kind of gusto. This was more of what I would put in the bucket of a scam pump overall. Now, slicing down through in December was the second period of time. Now, we've obviously got two examples here. We sliced below and we did in fact recover. Whereas in December, we sliced below and we headed much, much lower. So in many ways, in 2021, we have an example of a bounce and a not so much of a bounce. And these are useful frameworks for us to think about. So we're going to keep coming back to those three different examples. They're kind of good reference points for us to understand what's going on. So where we're at the moment, trading below the 200-day, below the short-term average. And I mean, we're consolidating above it as we speak. It's about 58K is the current price. We're at 58.8 for the 200-day. So who knows, by the time you watch this video, we may well have tried to take that 200-day, but we'll wait and see if that happens before we make any judgment calls. Now, what I do want to do is start with my framework for how I think about both trending markets, but also Fibonacci levels. Now, for those of you who've been watching this content for a little while, you will have seen me talk about quiet and trending. That's a really, really good framework to understand things from a volatility standpoint. The other one is important to understand it from a time frame perspective. And more often than not, I know myself, I've been guilty of this many times. I hear some piece of new information. It feels extremely bullish. It's something that's like multi-month or multi-year time horizon, and I start expecting it to play out in the next hourly candle. It's a big mistake. Lots and lots of people do it. It's very, very natural to feel like these things should get baked into the price, and we kind of lose the forest for the trees. So when we take that perspective, in my view, let's just look at the 2021 cycle. This was essentially a monthly uptrend. This is the forest. The forest is a monthly scale uptrend. Now, within a monthly scale uptrend, we have weekly scale corrections. What do I mean by this? You will see this as a monthly upleg. If you look at it on the monthly chart, say on TradingView, you probably won't see a great deal of the detail of all this chopping around. You will see this as a correction, but in the grand scheme of things, this is in a weekly time frame, a downtrend, which then reversed back to the upside, continuing the forest. The trees was the weekly downtrend, the forest was the monthly uptrend. Now we actually had a second bite at that cherry where it got a lot hairier and we filled in the entire triangle. Now there's a few different ways to think about this from a Fibonacci level standpoint. And again, where we want to measure the starting point to the ending point is always a bit of, it's somewhat arbitrary, but as long as you're consistent, it generally works. Here I've essentially taken the full rally. Now, what was special about 2021 is we just went up. There was almost no corrections or pauses. Only January was kind of an initial pullback, and then we just kept on going. On a monthly timescale, this thing just went up. Now, when markets just go up, they don't build a lot of support along the way. The only place that we did build support was this January peak, and during that correction, we found support down at that level. Now, if we look at that Fibonacci line, this was the 61.8, and this is what I deem to be the last stand. No matter which Fibonacci level or what part of price action you're looking at, once you get a serious close below the 61.8, generally speaking, you're going back from whence it came. It's usually a process, and we did do this, filling in and backfilling the entire bullish move or bearish move, if you're looking at this thing as a retracement in the other direction. So generally speaking, the 61.8 I deem to be a bit of a last stand. The bulls have to defend that level. Once you get below that, the probabilities are overwhelmingly that we're going lower. The 50% is kind of that in between. We are really testing investor resolve, right? It's hairy down there, but it can be defended, and as can the 61.8. But generally in this 50 to 61.8, you'll see me talk about this a lot this episode. This is kind of the bull's last stand, and we really want to see some kind of support come in there. Now, if we get a bounce, and this can obviously happen, right? All of these, I'm sure if you measured Fibonacci's within all of these smaller time frames, you'd see many instances where it bounces off the 38.2 or the 23.6. Up here, if we get a bull market where it's only bouncing off these levels, that's pretty strong, right? Getting 23%, 38% corrections, these are within the scale of a monthly uptrend, a weekly retest of these levels and then a bounce is actually extremely constructive. And we are really only talking about not even the 38.2 right now. We're talking about the 23.6 for the most point of our current correction. So, at the end of the day, this is what I mean in terms of structured market. You'll hear me talk about this feels very structured. We haven't even begun to get down and test these lower levels, which we'll touch on just shortly. But this is my big picture framework, the forest for the trees type approach. We really don't want to lose the 61.8. We probably want to find support at the 50. And if we find support up here and keep going higher, I mean, that's just happy days by my book. Okay, so there's a bunch of tools that I've recently rolled out to check on chain in the pricing model section. So you'll find all of these Fibonacci levels. I've essentially just measured certain points, right? Like this one here is basically looking at our October 2023 up to the ETF high. That's the Fib level. I haven't done all of them, but the concepts all still apply. But then I also have a series of pricing models. Now, these are all on-chain, or there's some technical models in here. We're not going to worry too much about them. Really, there's three, let's call them floor models that I'm going to pay attention to during a correction. And much like those Fibonacci levels, these aren't like the bear market floor. They're levels that delineate a bull market correction from it might be over bear market trend, right? These are the levels that you really want to see defended. And the reason why is that this is where investor behavior changes and shifts. Now, just for quick reference, the red zone down the bottom here, this is our 61.8 level. This is the reason why this is dark red. We probably don't want to spend too much time closing below here. That's probably not a great sign. The orange here is where we've got our 50%, right? And as we obviously climb up our 23.6 and 38.2 and all these things. So, right now we are just above the 38.2 level. We've broken below the short-term holder cost basis, and we have bounced off this purple line, and you'll see this across the next few charts. This purple line is the all-time average of MVRV. So what that means is this is the middle, the average of where if you take the cost basis of every single coin, this is the long-term average cost basis for every coin, right? This is where MVRV typically trades. It's kind of the average move for that particular oscillator at 54.5. Now, we sold off a little bit below this, but again, $1,000 between friends, we're not too concerned about those types of levels, right? And that also, right, happened to be a Fibonacci level, our 38.2. So we've had that initial bounce off that level, and where investors kind of hit their real center of gravity in terms of their unrealized profit, a complete reset and a complete cool down of MVRV. Now, slightly below this, we have the short-term holder cost basis, but a one standard deviation move below that. So when we talk about standard deviations, we can translate that into probabilities. Usually speaking, it's about 2/3 of all observations. Okay, we're within plus or minus one standard deviation, depending on how the data sample is populated. But essentially, 1/3 of all examples are going to be below this level. So in other words, it's more likely that we stay within this band of this -1 standard deviation and this short-term holder cost basis. There's obviously a level to the upside as well. Think about them a little bit like Bollinger Band. So this is like the lower short-term holder Bollinger Band. Now down the bottom here is actually one of the more important levels. This is the true market mean. Now Dave Puhl and I developed this as part of the Cointime economics framework. This is essentially the realized price, so the average cost basis, but instead of being per coin, it's per active investor. We remove lost coins. We remove all of the Satoshi and the early miners, coins that simply don't respond during this market cycle. That is what the true market mean is capturing. So let's peel back all of these things and just look at this broad picture. We're currently at the 38.2, or we've bounced off it. There was also a complete reset of MVRV. And just below that, we've got our short-term holder cost basis, which is down here at 52,000. So first kind of region of interest is essentially where we've come down, bounced off, and continued to consolidate around. So we're more or less in that zone as we speak. Towards the lower bound, in between our 50 and our 61.8, again, this is that level that you really want to see the bulls defending. We don't particularly want to see it get too much lower than that. We have the true market mean, which is about 46,000. So if we think about these as two different zones, this is obviously an area of interest, because if we were to bounce here, this would actually be within the scale of a weekly downtrend, monthly uptrend, weekly correction. If we were to bounce off here, this would be in our decent support type environment. This would be something that actually would be quite constructive. And I know it feels really doom and gloom right now, but strangely enough, this would actually be an extremely constructive and positive bounce. Now, if we were to trade lower than that and get down to say 46 or 45, we would hope, and I do mean that, I would really hope to see the true market mean hold. And the reason being that this is the average cost basis for investors. Once we get below here, we're not just talking about short-term holders that are under stress. We're talking about the whole market. And you could argue once we take out the MVRV level at 54K, we would also put a large portion. We're talking about top heaviness broadly speaking, not just in terms of short-term holders. This is where we start seeing a lot of people really being underwater. So a few different mechanics here, but let's explore what previous cycles look like so we can kind of frame this up just a little bit better. So starting with our May 2021 correction, because this one here is obviously bear market creating, seriously nasty, but we did get an all-time high bounce following that, right? So it's an important frame of reference. We found ultimate support at the true market mean, down about 29,000. We also intersected the 50% fib and our other two models, short-term and MVRV, just at the upper bound of that. So we essentially bottomed between the 50 and the 61.8 and between the MVRV and the true market mean. This is essentially a level that we did find support. It was the bull's last stand, and didn't they hold it, right? It obviously didn't last for the full time because we actually had that bear market that followed afterwards. But for many people, this is essentially a swing that if, pretend that that didn't exist, it's like, well, that's not an overly fair analysis. So it does make sense to just consider this and say, well, we really did find support there. We found it at a level which was kind of the bull's last stand, but they, sure as anything, they held it. Now, if we look at 2019 is a bit more of an interesting case. So what you'll notice, let me just quickly jump back here. Notice that in 2021, our on-chain metrics are a lot more stable. They're kind of smoother and they move with a little bit more of a structured pattern. Notice how in 2019, things are still moving around quite a bit. Now, this is because the market, as much as it, many of us, this is maybe not recent history, but within our time as a hodler, the market was a lot less mature back here. A lot of these models were a lot more volatile because cost bases were moving up, down, sideways. There's a lot more coins moving around. Mining issuance was, substantially larger, right? 2 halvings ago. So we've got quite a bit more activity going on, coins moving around. During this period of time, we actually had the Plus token Ponzi, which was kind of like the first example of an ETF, as strange as that may sound. It sucked up about 1 to 2% of all Bitcoin supply over in China. So an enormous spot bid drove the price from 4K to 14K in like 3 months. And then we had a chop solidation period, right? Again, ignore March 2020. This is a big sideways period of not much that didn't go very far, but it liquidated people left, right, center, all the way to the same price. Chop solidation 101. This is the kind of thing that's a really useful framework to just keep in mind. And note, again, we found support on that final last stand level, 61.8. We had our short-term holder, Bollinger Band, come in towards that lower bound. Same actually for March 2020. True market mean provided kind of that initial level of support. Our MVRV level is a lot higher at this point in time, but that's okay. These are all models. We're just trying to look for zones of interest where investor, behavior patterns change. In a way, MVRV functioned a little bit like the short-term holder cost basis. We had a lot of people who actually bought up here, myself included. I remember this very, very well. And I remember this sell-off very, very well. The sinking feeling of this, right? Thinking that we were going back to all-time high. We're forming a beautiful triangle. I don't know how many coins I bought here, but I remember feeling pretty nasty about it shortly after. This got me really excited. And then this was just shocking. This whole process was really, really painful. Lots of big candles up in both directions. Close your eyes. We went absolutely nowhere, but we liquidated people left, right, and center along the way. Really good mental model for where we are, but finding support at a very similar level. These are the types of mechanics that we're paying attention to. Okay, so if we bring that back and kind of summarize, what we've just looked at across those 2 previous cycles and similar examples, where we currently stand is essentially in the upper bound. I mean, this is still in the zone that I would consider to be structured and quite constructive. We haven't put the average market into a, call it a top heaviness, right? It's probably not going to be that extreme, but certainly a top heaviness type condition because you're now getting the average MVRV towards that middle ground. Our short-term Bollinger Bands down there about 52K, which we kind of tested on a wicking basis, right? These are our daily candles. So we got close, but we didn't quite get down to that level and stay there. We've rebounded since. And then our true market mean is what I'm going to call zone 2. And I'll refer you to the actual written report. You'll probably see this in a bit more detail. Down here at 45, 46, mid 40s, that really would be the level that we'd want to be holding. Statistically speaking, the true market mean is in the middle, long-term mean and median of 1, in terms of how much price oscillates around it. And we also spend 50% of our time below it, 50% of our time above it. Very strange, bizarre model because we came at it from first principles, and this is just how it behaves. So I really don't want to go below it because it kind of means that we might have spent our 50% above, and that may mean we have to spend 50% below. Personally, in terms of my conviction, I think that's a very unlikely scenario, and it's a bit of a fundamental take as well. That would more or less undo the entire ETF rally. And whilst Mr. Market may do this, that would feel like we've been over-penalized, is kind of the way that I would read that. So I think it's probably a lower probability that we get down to that level, but something I'm certainly prepared for. But again, that would be the 61% retracement, 61.8. It would be the true market mean. And we have seen that level defended in two fairly important levels in the past. 2019, which is very similar to now, and 2021, which was, in my opinion, much worse. Far less structured, far more just volatile downside. So in that instance, we've more or less defended those levels before, and I would expect at least the bulls to put up a pretty decent fight at that point. Okay, so having now set the scene for how the market structure looks, what do things look like from a technical and from an on-chain perspective, and again, we're really focusing only on the downside now. Given we're at that 38.2 level, how did the market respond? Well, the first thing that I find quite interesting actually is the ETFs were closed over the 4th of July weekend. So really only until yesterday, they've just watched their portfolio sell off, go down, because Bitcoin's obviously 24/7. They haven't been able to do anything for a whole weekend and some. Well, many analysts would have said that we're going to get all the degenerate traders, especially now that we're below the ETF cost basis at 58K, that we should actually be seeing everybody capitulating and bailing out, and this is the end of the world, and all the degen traders are going to sell the whole lot, except they're not. They seem to be actually seeing inflows, right? $294 million in inflows across all the ETFs yesterday on Monday. So again, this is not necessarily a trend, but what is a trend is declining price and lessening outflows into stronger inflows, right? Early days yet, but a sign that maybe they're not so degenerate gamblers, traders after all. We may actually have some hodlers in our mixed, and perhaps this may look like buying the dip behavior, just maybe. Now, another thing that's been quite constructive is in the futures market, we've seen a more than 2 sigma move, so a 2 standard deviation washout of open interest. Open interest has declined pretty meaningfully. We've actually now got a blue dot here, right? Blue dots mean a 2 standard deviation washout of open interest. People got liquidated. And this is a combination of people getting liquidated, the actual degenerate traders, but also CME is seeing quite a lot of closing out of open interest. So this cash and carry trade that we've been talking about may be starting to unwind. Now, again, this doesn't necessarily mean that it's going to bounce at this point straight away, right? Taking that forest from the trees approach. This is a healthy unwind of leverage. Typically, these healthy unwinds of leverage occur during major sell-offs. We can see here December, we kept going. But for the most part, we do actually see this as a fairly healthy unwind. So this is actually a good sign in the futures market as well. And we mentioned in one of our previous reports that we saw a bunch of people going levered long, right? This is not a good sign. You don't particularly want to see people getting liquidated on the long side as the market trades lower. Now we've got a few people getting liquidated on the short side. Now it's not a short squeeze, but it is a resetting. People seem to have given up, at least for the time being, going levered long. That's a good sign. That's a cooling down. Doesn't mean that leverage can't rebuild, but for the time being, it's removing some of that volatility. It's probably not likely we're going to get a big long squeeze to the downside again. It feels like, at least for now, that's cooled down quite a bit, which is, again, a good sign. Now, the one group that does give me a little bit of pause, and we do have to be conscious of, is the short-term holders. Now, I know that we're on that MVRV line, but short-term holders, 92% of their supply, this is the percent supply in profit, 92% is in loss. Only 8% is in profit. Short-term holders, which again is pretty much the entire top consolidation buyers, just about everyone's having a pretty horrible time right now. They're nursing about $41 billion in unrealized loss, which is not small. It is meaningful. So I suspect that the short-term holder cohort is going to be one group that will provide supply overhead, right? They're going to be the one that we have to work through. So patience is going to be probably part of that game, I would suspect. We are seeing an uptick in their realized loss. So again, it's one thing to be underwater. It's another thing to actually sell, because you have to actually panic and sell those coins to create sell side pressure. Just because you're holding underwater coins, which I've got some underwater coins, if I'm not selling them, who cares? It doesn't matter anything. Only matters if they actually sell. Now, it's a bit hard to see, and I'll go to the next chart in a second to zoom in on this, but notice that where we are is not too, we are the higher bound, so it's the upper bound of 2023. So we're getting more panic than we've had previously, but also it's not this. This is full-scale capitulation, granted, in a bear market. This is the start of a bear market in 2017. This is the start, well, this is March 2020, right? So you can see that there's a bit of a character shift when we get to May 2021. We're not quite at those levels of realized panic just yet. If we look at things in terms of dollar terms, you can see an acceleration. We're getting higher and higher losses as we trend higher, right? Here we are back at the actual ETF top, right? We got a whole bunch of people who actually started locking in losses as we pull back off the top. There was a whole lot of people who actually started to panic very, very early in this correction. And there was even going to be some people who would have actually held their coins from at a higher level and sold down at these points. But here we are locking in over $400 million in a single day, actually, as we sold off. So fairly substantial realized losses, something not to be taken lightly. It looks like we're going to have to just work our way through these short-term holders for the time being. You can see the magnitude of the May 2021 sell-off, really just seriously brutal stuff, or more than double where we currently are. So it gives you a bit of a sense of scale, not quite as severe, but also 38.2 versus 50 to 61.8 in terms of Fibonacci retracements. Okay, so the very last topic that I want to touch on, sticking with this theme of short-term holders, let's just understand their overall profitability. Where do they stand? What kind of risk vector do they pose? Well, if we look at their MVRV, which again, this is their unrealized profits, like an oscillator that shows how in the money, high values, or out of the money, underwater, for low values they are, we are down into negative territory on the Z-score. We never visited this level in 2016-17, right? So we have not got down here in 2016-17. 2019, we actually found our floor down here at these levels. May 2021, we got below this, right, down to the next level, 1.2 standard deviations. These two, 2019, and then here again in 2021, these are the only two examples. Not even August 2023 got this low. These are the only two examples where we have reached these levels and then trended higher. Now, in 2019's case, we had some chop solidation to get through that process. In 2021, it was a fleeting uptrend because we'd broken the back of the bull. Now, just gut feel, I don't think we've broken the back of the bull the same way as we did in 2021. It doesn't feel like that. It feels a lot more like 2019, which really gives me that gut feel that chop solidation is probably the most likely result. Continuation of what we've been talking about essentially since Check on Chain Newsletter launched. This chop solidation process, it will work itself out. It will go through this process. I don't necessarily think we deserve to give back the full ETF rally, but I'm also prepared for it. I don't think that we necessarily deserve to crash below the true market mean, but I'm prepared for it, right? So these are just some of those things to think about. We are not in uncharted territory, but we are in thinner air, right? So it's just one thing to keep in mind. Now, to close out, this is the population. Think about the population of that short-term MVRV that we just looked at, or the Z-score. This is basically looking at where does that metric typically trade. Now, I've got two traces here. For those of you who've been around the newsletter for a while, you'll have seen charts like this before. For those who are new, let me explain what this is just one more time, because these are really, really useful charts. Just understand probabilities and chances and, where we kind of sit in the grand scheme of things. Imagine if we surveyed the short-term holder MVRV and said, what value were you on every single day through its entire existence? This is the bell curve that shows all of the closing values, right? The higher these are, we've had over 100 times that short-term MVRV has been up at these levels. Now, where we currently are at negative 0.8, you can see we're on the left tail of this population. Most of the time, short-term MVRV is higher than this current value. Now, the reason this is green is this is only looking at bull markets, right? We don't care about bears at this point in time. We do have options for whole market, bear, and all that, but let's just start here. During a bull market, let's just allow ourselves two assumptions. Let's assume we're still in a bull market, just to take that case. Well, only 13% of all days have been lower than that, which means 87% of all days have been higher than that. In other words, the gravity for this metric, if we are in a bull market, the gravity for this metric is higher, right? Which is obviously price climbing and or short-term holder cost base is falling, but let's just, for simplicity, it's price moving higher. So there is a 87% chance that the market wants to move towards the upside if it's a bull. We're getting down into the territory, right? It depends. This is useful for actually defining a probability, so to speak. But for me, if we're down in the 10%, right, only 10% of history is down there, that means I've got a 90% chance that it wants to go higher. If my bias is to the upside, to me, I'm starting to see a value zone. And I combine that with things like the 38.2, and I combine that with if we got down to the 50% or the 61.8, we'd be getting to the far left-hand side of this tail where it's like, only 2% of trading days or 5% of trading days. Low probability outcomes like that, as a sat stacking hodler, that feels like an opportunity to me. That's somewhere where I'd go, yeah, I kind of like that discount. But let's be really, really conscious to always look at two sides of the equation. What would happen if we were in a bear market? Now, of course, you don't know it's a bear market until after the effect. These values of short-term MVRV up here are essentially when the top is in and we've descended down into the bear, right? So these are the final values before we land, and the population, as you can see, is below the neutral value of 0. Short-term MVRV spends time well and truly below its long-term mean because it's super bearish. Now, if we only look at bear market values, we are dead center, 50-50. So what that means is that half of all trading days in a bear market are higher, half are lower. Generally speaking, because we're in the middle of the population, we're going to spend a lot of time here. In other words, chop solidation, right? If we are in a bear market, my instinct here is that we're not at some kind of extremely low level and a bounce is coming. We're not at some extremely high level and it's like, well, put your crash helmet on because we're going lower in a jiffy. This is really telling me that we are in the middle of the body of the candle. We're not going anywhere anytime soon if it's a bear market. And as a result, chop solidation is the most likely outcome. So if we take both of those kind of scenarios, we've got our bull case where it's like, I'm looking for opportunities. That's how I look at these things. I'm looking for levels where it's like, well, I want to see the bulls defend it. These are areas that I find kind of interesting. This is where I think that behavior will start to change. If we're in a bear market, well, we're in a bear market and chop solidation is probably in our future. So some amalgamation between the two with 2019. And this is why I come to the conclusion that 2019 is a good and useful framework, right? I remain personally relatively constructive overall, but at the same time, right, just looking at both sides of the equation, I think it's a useful way to just understand what is okay, what is expected, what is the forest, and what is the trees. Thanks, folks, for tuning in for that. If you have any questions, you can always reach me in the Substack, and I'll catch you in the next one. Cheers.